Thanks for joining QIC's Market Watch, where we track the Iran war. I'm Matthew Peter, QIC's Chief Economist, and I'm joined by my colleague and QIC's Senior Economist, Linda Burke. Hi, Linda.
Hey, Matt.
Well, we're fast approaching our end June deadline for the reopening of the Strait of Hormuz, which would keep us in the benign economic scenario. And it would also keep us from shifting or sliding into that malign scenario. As the war has dragged on, however, we've also seen the trading range of the oil price shift higher over the last month, from between $90 to $100 a barrel to now trading within a range of $100 to $110 a barrel. That's still some way off our malign scenario, which would see oil trading in a range around $140 a barrel. Nonetheless, it's not in the right direction. So, Linda, I know you've been looking at global oil supply. What's happening there? How are we tracking?
We got the oil market report from the IEA, the International Energy Agency, last week, and it showed that global oil supply is down by around 14 million barrels per day since the strait was closed. Now, that's a big number. It's unprecedented, but it's not actually as bad as it could have been, given that around 20 million barrels per day was what was being exported via the strait before the war started. So we've seen a few factors that have sort of supported supply within the Gulf region. While the shipping has been closed via the strait, there's still some oil getting out of Saudi Arabia and the UAE via the pipelines. And there's also been rumours ongoing that ships are getting out through the strait by turning off their transponders or paying a toll to Iran for freedom of passage. So there is still some supply coming out of the Gulf. In terms of supply outside of the Gulf, it's also responded. There's been a really big lift in production and exports out of the Atlantic basin. So US, Brazil, Canada have all lifted production. I guess probably the biggest adjustment, though, has been from the coordinated release of stockpiles, and that's added significantly to supply, around 4 million barrels per day.
Yeah, well, I think too it's important to clarify that, as you said, 20% of oil supply comes out of the Gulf, but really it's but it's down about 14 million
Yeah,
barrels a day.
yeah,
And that's what
only.
generates that sort of hit to price. It should keep it in that band between 100 and 110. It would only be if those factors dissipated and we went up to a loss of 20 million barrels a day that we'd get a sort of a breakout in price beyond that sort of band of 100 and 110. Nonetheless, the longer it stays there in that range, the oil price, the greater the risk of pass through to inflation and whatnot. So you're saying supply is gradually adjusting to make up for the lack of oil. That's what I take away from what you've just said. I suppose the other side of the equation is demand. So what's happening on the demand side?
Yeah, well, the higher prices are reducing demand, but it's only worth a couple of million barrels per day. I guess the most notable adjustment on the demand side has actually been through China. So Chinese import demand has fallen off really sharply, and that's despite their economy still doing pretty well. So we don't know exactly why, but we can guess that they're either the beneficiary of some of the cargoes that are secretly making their way through the strait, or they could actually be using some of their enormous reserves to supply the domestic market rather than importing oil. So that's actually been the most significant reduction in demand that we've seen. So, there are a number of equilibrating reasons why oil prices haven't skyrocketed despite the strait remaining closed. And it demonstrates the adaptation that the global economy is capable of. And it sort of reminds me a little bit of how supply chains adjusted when Trump brought in the Liberation Day tariffs last year. There was a really sharp rediversion of trade from some countries to others. And the economy, the global economy last year was more resilient than we thought it would be to the Liberation Day tariffs. And I think we're seeing some of that resilience in the global economy now. But regardless of that, the stockpiles can only take us so far. And given the heavy lifting they've been doing, it means that the reopening of the strait remains really crucial to seeing the supply return to normal levels and allowing prices to fall.
Yeah, clearly the strait has to open to get back to those conflict level prices. But even if the strait doesn't open, it doesn't necessarily mean the price shoots through the roof, as you say, because the longer the strait is closed, the longer that the economy is adjusting, then we can adjust supply and demand to the drop off in supply coming out of the Gulf, but it will be at a higher price, not necessarily
That's
some
right.
stratospheric price like $200 a barrel, but it won't see the price drop probably from this trading range we're seeing currently between 100 and 110. So even if the price doesn't shoot up from here, and in our malign scenario, we did have it going up to 140, even if that doesn't happen, because of these adjustments, the longer that the price stays high, then of course the greater the risk to embedded inflation. Now, I'll just take it away from the world for the moment, and I'm pressing you hard here, Linda, I know, but I also know that your team's been closely following developments in Australian supply. So how are we faring?
It's actually pretty interesting. So while the rest of the world's been running down their inventories, we've been buying up all the fuel we can, and we've actually increased our fuel supplies since the war started. To be fair, we did start out with stocks that were pretty low, and we're still pretty low by global standards, but all of the hard work the government's been doing with our Asian neighbours to source fuel has actually been paying off. And we've now got sort of between 4 and 6 more days of fuel consumption stockpiled than we had at the end of last year, and that's across, petrol, diesel, and jet fuel.
So the $64,000 question, Linda, when do we run out of oil?
Well, that sort of depends on how much access we have to imports, right? So if we just do some back of the envelope calcs, we know that the two refineries that we've got left operating in Australia produce around 20% of the refined fuels that we consume. So that means we're relying on imports for 80% of our refined consumption. But it's even worse than that because of the crude that we use to produce the refined fuels domestically. Around 80% of that's also imported. So that means only about 4% of our petrol, diesel, and jet fuel is produced domestically using domestically sourced raw materials. So around 96% of the fuel we use is imported. So to date, we've managed to maintain all of our normal flows of imports and some. And if we can continue to do that, we won't run out of fuel. If our imports fall to around 80% of their normal levels, the combination of those imports and the existing stockpiles that we have should see us through until the end of this year, maybe a little bit longer for petrol. And if we can maintain 90% of our regular imports, so that's like a 10% drop in supply, given we're a relatively wealthy nation and we can afford to pay the higher prices that could result in that scenario, and we've also got a government that's underwriting our purchases of fuel, we shouldn't run out until the middle of next year. So I guess what I'd say is running out of fuel probably shouldn't be our number one concern at the moment.
Yeah, in this sort of back of the envelope calc where you still have demand tracking conflict levels, we drop 80% of imports. We've got till the end of the year before we start to run into shortages. So
That's
that
right.
gives us a bit of time, doesn't it? Before we get into genuine troubles. However, I will point out the longer the strait remains closed, the longer it is that the global economy is looking at this deficit, even if it's only not the total 20%, then we will get to a point probably. I doubt if we'll get shortages, but we will have to pay a higher price at the Bowser. That's the bottom line, isn't it? If
That's right. And that
the
means more inflation, higher
yeah,
rates,
yep.
risking embedded inflation and moving into I guess,
Mm.
the risk of a malignant scenario. But Matt, I feel like we've come full circle. We're back to where we started. It's really important that the strait reopens, and so there can be a resolution to this problem.
Yeah.
Where do you think we're now tracking with the conflict?
Well, as I said, we're getting close to that deadline of the end of June. The data is now starting to give evidence that there is pass through beyond the Bowser to other parts of the economy, Linda, in terms of inflation. There's not a lot of data out that's indicating that it's hitting growth yet, either in Australia or the rest of the world, although there are some concerning signs about coming from indicators, both business and household, that there's businesses and consumers are starting to worry about the effects, but that's only
Yeah,
really
confidence is really tanked.
but confidence hasn't been a good indicator of how people have
No.
actually behaved in the past. It's very volatile. So we sort of take those indicators with a grain of salt. In terms of the oil price with the announcement by Trump, here we've got the dichotomy opening up within financial markets, and probably, I would say the same for the outlook for the economy, between those that believe that the conflict will be passing, will be temporary, and believe that AI will be the main driver of growth going forward. And those parts of the economy and financial markets that believe the outlook's going to be dominated more by an ongoing impact of the conflict. Even as the Strait of Hormuz open, we're pushing towards a higher interest rate, higher inflationary world. And that dichotomy is particularly played out in financial markets at the moment. And the good news, well, the apparent good news that President Trump delivered about an imminent resolution of conflict, we saw equity markets rally. So equity markets are up; they're hitting new highs once again, notwithstanding the conflict. So the equity market is voting basically that AI is going to drive the outlook, whereas bond yields are up. Bond yields are up 70 odd basis points, almost a percentage point from their levels from before the conflict. So the bond markets, both in the US and here in Australia, globally, are saying no, it's the inflationary outlook that we've got to worry about. The conflict's contributing to that. We're going to have higher interest rates. And really, we've got two forces fighting against one another in markets. The question will be, how much can equity markets and the economy withstand higher inflation and higher costs of borrowing as interest rates go up? Which will crack first? Will interest rates come down, or will the higher interest rates, higher inflation, crack the equity market and crack the economy? That's what we're worried about, and that's what will see us drive through to malign and perhaps even to the malignant scenario at this point, Linda. So thanks everybody for joining us. Linda and I look forward to you joining us once again as we track the Iran war.